If you want to understand if you can make money investing in Roxgold, you need to watch this video. Hello and welcome to our viewers on cruxinvestor.com, and for those of you new to Crux Investor, please click the button in the corner of the screen to subscribe to our YouTube channel. Today we're going to be discussing a few things with John Dorward, the CEO of Roxgold. We're going to cover his recent drill announcement, their strategy and how they're piecing that together, and the fundamentals of mining in Africa and what the competition is up to, and if we can, we'll get a prediction out of him. These topics and more are in the description below. Click on the relevant timestamp and you'll go straight to that part of the video. So let's talk to John. John, how are you?
I'm very well, thank you. Good to see you again.
Yeah, we spoke recently online. I think you were in Oz.
It's much better in person.
It is, always is. So what we're going to do today, if you don't mind, give us a 1-minute summary of the business, then we'll kind of get stuck into it.
Sure. Absolutely. So Roxgold is a development and operating gold mining company. Our principal asset is the Yaramoko gold mine in Burkina Faso, which Roxgold discovered in 2011 and put it into production in 2016. So it's been in operation now for 3 years. It's a very profitable, very good operation. It's been a strong underpinning source of cash flow for our company. And we just made our first significant investment in terms of growth by buying the Séguéla Gold project in Côte D'Ivoire from Australia's Crux Mining.
So let's talk about that. I want to paint a picture here for investors who are watching this on
Sure.
Crux Investor. You outlined a strategy to me which I thought was fascinating. You thought, right, we've got an asset, we're going to, rather than the kind of work out what you've got on the ground, you got quickly into production. And that's given you the cash to be able to look at additional acquisitions, but it was also out of necessity because of the mine life at Yaramoco is what it is, and we can maybe get into that now. Tell us a little bit about Yaramoco, what you saw there, and perhaps what the restrictions were in terms of things like mine life.
So, I mean, Yaramoco is really a great asset. It's really, I think, for a company that's starting out and is a junior with a development asset, Yaramoco is exactly the sort of asset that you want to find. High grade, so extremely high grade, double-digit resource grade. We've been mining high grade now for 3 years. The interesting thing with respect to the mine life is that we published a feasibility study in 2014, which showed that we had a 7-year mine life at 100,000 ounces a year, so 700,000 ounces of production. We've been in production now for 3 years. We've produced over 350,000 ounces, and we still have a 7-year mine life with 830,000 ounces of resources.
So you're continuing to drill out and step out and work out how you can develop that body there. And in fact, you mentioned when we spoke last there were a couple of other targets you're looking at in and around Yaramoco.
Oh, absolutely.
How's that going?
Yeah, no, it's going well. So we've had a very active program of generating new targets, which we're setting up to start targeting and drilling in the second half of this year. I think as with a lot of projects, the brownfields potential is always the most compelling. If we can find another deposit like Bagassi South or the 55 zone, which are currently in operation, then the returns to our shareholders and the company should be very good. So that's motivating the search in and around where we've got. So
let's get into some numbers there with Yaramoco so people understand that, because I've talked about short mine life, but you're extending that out slowly and surely. You've got a good team there. Looked at the track record of delivering. Mining's mining. It's tough. It's hard work. There's no kind of easy shortcuts here, but you've been kind of building that out. You hope to grow that and extend the mine life even further.
Yes.
So what are the things that you are looking at with your team on a daily basis? What's the things that are kind of keeping you awake at night in terms of needing to deliver?
Oh, really, continuing to deliver consistent production is the key for us. So if you look at our track record, we've tried to establish a record of under-promising and over-delivering. I think if you look at our first 2 full years of production, being 2017, 2018, both years we increased our guidance and then came in above the top end of our guidance range. This year we're guiding to what would be record production at Yaramoco. The guidance range is 145,000 to 155,000 ounces. We're very much on track to deliver that guidance again.
Yeah, I mean, I'd encourage viewers to go to page 4 of your current PowerPoint. It's got some quite interesting numbers on there. Just kind of back that up. But so, I mean, it's been a cash cow for you. You created enough cash. I think shareholders should be happy with what you built there. it's enabled you to have enough cash to look at the second asset, which is Séguéla's one. Can you tell us a bit about what you saw there and why you've gone for that?
Sure. It really plays to, our real strategy, which is to offer per share growth in both resources, reserves, production, but most importantly, earnings and cash flow. Slide 4 of our current presentation, I think, is a good starting point where it shows on a per share basis how we've gone, and it's some pretty impressive growth in terms of production and especially resources. So what I think happens with a lot of mining companies, and this is sometimes why I think investors may have a bit of a jaded view of the mining sector, is that the mining companies chase growth pretty much any costs, and a lot of that comes with issuing shares to acquire new development assets or new producing assets. And we think that it's very difficult to deliver long-term sustainable value in doing such a way, because if you're buying someone else's producing mine or you're buying someone else's development project, they've probably surfaced a lot of the potential value. We would like to do that ourselves. We believe we have a team and we have a good cash flow, so we'd like to take an asset maybe at an earlier stage, invest capital in it, invest the expertise, de-risk it, move it along, and ultimately make it more valuable.
So how do you do that? Because obviously no one sells good assets, right? Or if they do, they don't sell it cheap. So you've got to come in at an earlier phase. Makes sense. But there's a lot of crap out there too, right? So what are you looking for that says this is the one out of the 100 that we've looked at?
Yes. Well, you're absolutely right. There is a lot of crap out there. We've popped the hood on a lot of assets, both operating and development and exploration assets, and to be honest, often not as advertised. And I think that's something that we're concerned about. With Seguela, which is our first acquisition, I think it's a really good case study to understand how we look at opportunities and what we want to do. It came out of Newcrest. Newcrest is Australia's, as many people will know, Australia's largest gold producer. It's the third largest gold producer in the world, and really has a strong exploration focus. I mean, Newcrest has discovered the majority of its assets over time, so it's really focused on exploration. Exploration is held in high regard.
So why they sell it to you?
So it probably looked like it didn't make their size threshold.
Right.
As I mentioned, the third largest gold company in the world, the asset now, we just published a new resource at nearly 550,000 ounces. So I guess they couldn't see visibility to the 5 million plus ounces that a company of that size needs to be able to justify the effort.
But you're not looking for that, certainly not day one.
No,
You've
I'd
got
like to find it.
Sure, that'd be nice. Yeah. But this is what I'm trying to get at, so investors get a sense of what your thinking is here. You're not looking for world beaters, global scale assets. You're looking for a kind of mid-sized, profitable, low operating cost, high, reasonable AISC to this, and piecing together this picture. So, tell us about the thinking. That's what investors want to understand. How do you think about these things, and why does that make sense, and how are you going to deliver it?
Sure. So I think we have the belief that little fish taste sweet. Yaramoco,
beautiful.
And we think it's not done, and we're finding more gold there, but it's not a world-class scale asset, although very profitable. So we've taken that model and said, okay, we believe this is an interesting model. This is a way that we can operate in a competitive landscape and still add value on an appropriate risk and reward basis. So buying Séguéla at just north of 500,000 ounces for $20 million of cash, and that's very important to us because we were able to pay cash that we generated at Yaramoco.
So no dilution.
No dilution.
And I know the share count has barely risen in the last 2 years, 2.5 years.
So we haven't issued shares in terms of a traditional equity financing since early 2015, and we want to keep it that way. We want the owners of Roxgold to enjoy increasing share of resources and reserves and profitability and earnings and cash flow, as opposed to having to share that with new shareholders who've come in on the back of a dilutive financing.
Okay.
So Seguela presents itself as an opportunity we can get into at a reasonable price. It's $20 million on the barrelhead that we've paid to Newcrest, another $10 million payable upon first production. So we think the risk is shared there. If the project doesn't make the production hurdle, then we don't pay Newcrest $10 million. If it does, we'll be happy to pay that $10 million.
For sure, but if you don't, you're 20 million into this, albeit with cash you've generated. It's been a non-dilutive exercise, but why is 20 million a good price?
Well, we believe it's an excellent price. So we believe as I say, Newcrest were motivated to sell because they didn't see the long run pathway. We can still have a very good asset, anything above what we've found today. So we believe today, as it currently stands, Seguela is an economic asset and will be the next gold mine that Yaramoco builds.
But the resource is 500,000, right?
Absolutely.
So is that? I mean, normally I wouldn't look at anything under $1 million. So what are you seeing?
And to be honest, I think that's the sort of thinking that we're trying to take advantage of.
Great.
Perseus has just built a new project in Côte d'Ivoire called Séguéla, which has been, I think, very successful for them. It's actually a smaller resource and lower grade than what we have today at Seguela. So I think there's a good case study that this can be worthwhile.
Well, case studies, neurology, whatever, that doesn't answer the question about what you're looking at. What are you seeing over and above the data that Newcrest has given you, which says, I think we can make this bigger?
Yeah, so we see, the resource we've put out, 530,000 ounces at 2.4 grams, will get bigger from the recent drilling that we've done. So we've done some additional drilling recently in the last few months over and above what's included in that resource.
Right.
And we published that earlier this week.
But that's a kind of post the event thing. I'm intrigued by, again, the thinking. So you agreed $20 million plus $10 million with the data you had, the drill results that you inherited or you were allowed to look at before you decided to make that decision. What did you understand that others didn't?
Well, I think we understood. I think it's probably buying option value at a reasonable price. And when I say reasonable price, I mean we bought a project that we thought would be economic and we could make money off what we saw if it didn't get any bigger. Now,
right, okay.
550,000 ounces doesn't ring a lot of bells for people, but when you come from a company that our size, it's still a meaningful increase in production. So we're realistic about where we are and how big we are. So we saw our base case was squared away with a economic asset. We then saw that there was a series of other potential deposits that Newcrest had done work on all around Seguela. And if you look in our presentation, you'll see a map with concentric circles. So within 10 kilometres of the antenna deposit, which is the current deposit that has a resource at Seguela, there's over a dozen targets that Newcrest has delineated, some of which are quite advanced, mainly Boulder and Agouti. We put those results out earlier this week.
Right.
Some additional drilling that we've done, and you see very attractive, high grade over broad intervals close to surface. So we're very confident that some of these, and we were very confident when we bought the project.
So it's page 17 of the PowerPoint, I think.
That's right. So if you look at that, so we were very confident that some of these additional satellite targets would make the grade and would become additional feed sources for a central mill. So it wasn't a question that we had to grow antenna, the one with the resource. Yeah. It didn't have to make that any bigger. What we wanted to see was some of these additional elements that would improve the economics.
Got it. Would you have done that deal if you had to borrow the money?
Yes, I think so. Yeah, okay. I think if we'd had the borrowing capacity, we're relatively agnostic to capital. I mean, if you borrow the money, you have to repay it. I mean, we have a relatively modest gearing level, so we'll be able to do that.
But there's a very different conversation with shareholders. You're going, right, I'm borrowing some money, diluting the company down here. I appreciate your market cap is where it is, but versus actually we've got the cash, we're going to give this a go because the optionality looks good to us.
Yeah, no, I think that's right. And I think being able to go to Newcrest and say, here's a cash offer, I think that was a competitive advantage for us.
You could close the deal a lot quicker.
Yeah, and we always look at where we sit in the competitive landscape. So we think we've got an area that sort of flies under the competition of the larger companies. Even sort of the mid-cap companies that are well capitalised are probably looking for projects bigger than us. And I don't want the viewers to think that we're deliberately looking for small projects. We just think that on balance, there's probably more opportunities for us.
And less competition.
That's right.
And less competition comes, the price doesn't get inflated.
That's right. And Newcrest, and I don't know what other offers they received, but I imagine there would have been offers from very junior companies that had a lot of script in it. So Newcrest would have ended up being a large shareholder of a junior without a cash flow, and then really sort of hostage to the success of that company being able to finance and take the project forward. With us, it was a clean exit. We've known the Newcrest people very well, and I think they've seen what we've done at Yaramoco. And I think for a large company, and especially one like Newcrest, leaving a good legacy of where they've been is important. So they want to see it go to a good home, people who will be, good operators, good stewards, and we've been able to demonstrate that in Burkina Faso. The Minister for Mines of Burkina Faso actually wrote to his counterpart in Côte d'Ivoire, giving us a recommendation and endorsement.
Yeah, always good. Always good.
Transfer of the license.
So, Newcrest, are they sitting on more assets in West Africa that you're aware of?
They still have a joint venture position with Barrick that they inherited part of the Roxgold acquisition.
What's that doing?
I'm not really sure. They don't talk about it a lot, but
Okay.
I'm always interested to learn more.
So are we.
Yeah.
So are we. Okay, so that helps us understand a little bit about your thinking. The small fish don't taste sweeter, and you think you've got the team to be able to extract the value there, and there's a big kind of list of things to look at in that portfolio that come along with Seguela.
That's right, and I mean, if you go forward, so I mean, we've talked a little bit about what attracted us to the asset, but if you roll forward over the next couple of years, so we will deliver a preliminary economic assessment later this year, and I think the opportunity is that, you know, in talking to analysts and investors who are active in Roxgold, a lot of them are still carrying this asset at $20 million in their valuation, what we paid. So I think when we table a PEA, and not to front run what that will look like, but I think it's going to look a lot better than $20 million.
Well, it's interesting. PEAs are different. You know, people have different views of PEAs in terms of their accuracy and the relevance of them. So yes, some people might like it. Some people may wait for the next step. Okay, but let's talk about. Actually, before we talk about drill results, we'll come on to that in a second. Is your share price? You took a big hit. We talked about this in the last conversation. We'll put a link up to that interview. But let's talk about that here. Share price took a bit of a hit because of some selling. You believe? Well, what do you tell us about that?
Yeah, look, I think we've actually recovered a little bit.
You have.
In the recent
you
last
have.
week or so.
But I want people to explain, because if they look at the chart, they're going to go, oh wait, there's something going on here. But it's explainable. So why don't you?
Absolutely. So it's been quite an eventful 12 months for Roxgold in terms of its share register. Probably a lot of your viewers would have seen this rippling through junior mining companies when M&G lost their Vanguard mandate
2 or 3
July of last year,
yeah,
and that went to Wellington. And we've and I think we might have talked a little bit about that. So that was announced, I think, in July last year, when we were trading at a point of $1.40. And you know, we're not looking to make excuses, but when you look at the share graph performance, basically from the day of that announcement, it trailed from $1.40 down to 70 cents or thereabouts as that overhang leaned on our stock, and that is there's a bit of a subtle difference that's happened too, because we historically have been a fairly thinly traded company. So we've got a good number of very long-term loyal shareholders who own big chunks of Roxgold and don't sell them, and don't buy more, don't sell more. They're happy with their position.
Yeah.
So we've had limited trading.
Yeah.
And so when you have your second largest shareholder loses its mandate and everyone expects it to be sold, which it subsequently was, that's a bit of a problem for you.
Yeah.
So that predictable response, share price down, that cleared in late January. So there was a deal done and a block traded, which went to a lot of good homes, good long-term strong hands. And that really marks, the share price has turned around quite a bit since then, and that's been very helpful for us. And what that's also done is it's really increased the velocity of our trading. So our share trading has gone up considerably. Yeah. And the upshot of that is interesting, because one of the key sort of structural shifts in the junior resource market has really been the rise of passive investing, and that's not just junior resources.
Sure,
that's
ETF.
Across the board.
Yeah, we've talked about them previous interviews.
So we're well on track for inclusion in the junior ETF, the GDXJ, at the next rebalance. So
how do you know that?
Well, so you look at the criteria for entry, and it's pretty straightforward. You need a market capitalisation of greater than 150 million US, so that's a check for Roxgold. And you need to have an average of $1 million per day traded for 3 consecutive quarters. Now, they're not calendar quarters, so this current quarter finishes in August. But we've already cleared that hurdle for 2 quarters. We're halfway through the 3rd quarter, and we're trading at over 1.5 million US a day as we speak. So, if that's a big deal. The GDXJ is a big deal, because you're looking at a significant new shareholder buying onto the register, right? And also that facilitates other shareholders, I think, who may be looking at being tied to the index, and then increasing our liquidity. Great.
Okay. Well, I hope that comes, because I think for retail, family, office, important, and high net worth, that's a big deal. Yes. It shouldn't be understated. No, okay, so we will watch out and see if that happens. Now, generally, I'm looking at things like your ASIC and your overheads and your costs and your G&A and all of that sort of good stuff. And I always ask the CEOs in terms of what do they think juniors should be paying their board, their management, and how do they remunerate each other? Is it incentivized on deliverables, or is it actually, I'll just take a big salary here? How do you guys look at that? How do you approach that?
So I think, and I mean, there's a lot of commentary on what's the appropriate
Quite
mix
rightly.
for shareholders.
Quite rightly.
I know it can be a hot button item for a lot of people. I think with Roxgold we have a combination of fixed and variable pay, and really it's fixed pay is a salary, and the rest is really to be put at risk. And there's two components to the risk-based salary. There's the short-term and long-term. Short-term is really set around delivering metrics. So for myself and for my team at Roxgold, we're incentivised on a variety of metrics. Safety is first and foremost. Production targets, making sure we hit various milestones in terms of development.
Who sets those?
That's set by the board.
So the board set the targets by which they're remunerated.
No. So the board don't have those sort of targets. This is for the executive team. I have to be on the board, but this is for the executive team.
Got it. Okay.
So you have to deliver, and there's a range, and if you don't deliver, then you don't get that component of your short-term incentive.
Right.
And then on the long-term incentive is essentially fully tied to shareholder returns.
And who watches the watchers, as it were? Because I've been talking to a company, let's say in the last 2 weeks, can I keep it vague? They have a little bit of production. They have a market cap of circa somewhere between 200 and 300 million, and their board pays themselves as much as the Kirkland Lake board. I'm like, wow, that's pretty ballsy for a low revenue business. So I can sort of see we get a lot of communication from investors that are saying, well, what are the rules? Who manages that? Who oversees that? Because people forget to read the prospectus when they're putting their money in. If there's a private placement or if there's a fundraiser of any description. I mean, it's just interesting how juniors manage that. Yeah. So I guess
who's watching the watcher, and it's not an exact science, but I think the rise of the proxy advisor has been interesting in recent years. So I'm sure a lot of your viewers are aware, a lot of funds sort of are advised by proxy advisors, and these proxy advisors comb through the management circulars and annual reports to see what the pay mix is. And they basically have a recommended approach. They have a template, and that's largely in line with what I was saying. So there's things that they don't like. They prefer whole share units over options because they're less dilutive, things like that. They want to see performance metrics that if your company outperforms its peer set, then that's good. If it underperforms, then there's less reward. So they want to see that the management team, makes some gain when the shareholders and the company's doing well, and feels some pain on the downside.
We're here to help investors understand why they should invest in Roxgold. So let's get back to that picture painting.
Sure.
You've got Yaramoco. You're enhancing that. You're continuing to work and extend that life of mine. Very high grade, very low ASIC. It's a good, solid project, and you will keep sweating that. And it's producing cash to give you the freedom to do things. You've just bought Seguela. You like what you see. You've explained why you bought it, why you paid the price that you do. So how do those things sit in terms of your vision, the complete picture, the overall picture of what Roxgold could be? Okay, without getting into there, we're going to get into development, etc. We will never sell. It's all of that stuff. Don't do that. Do the reality. What are the options for you if you build this out the way that you could?
Okay, sure. So the first and foremost is to try and make as many things as you can, put them under your control as best you can. So there's a lot of variables that we can't control in our business, price of gold.
Absolutely.
Whatever. But what we can control is our capital structure to a certain extent, and for us that's very important. And on the theme of why we went to Seguela, the beauty of this project is we can build this out without raising another dollar of equity. And that's, as I said, we paid cash because we didn't want to issue shares. From cash on our balance sheet and cash from Yaramoco, and probably a combination of a recut financing or project finance arrangement, we should be able to build Seguela without going to our shareholders and asking them to dip into their pocket to fund our growth. And I think that's important. So that's really a sort of set in stone for us. That's what we want to do. So ideally, we would like to find a third project.
Yep.
And if we could rinse and repeat the Seguela style of experience, we would do that.
Yep.
Because I think we could then schedule that to come in after, say, Seguela.
Yeah.
And again, if we could do that, by minimising or avoiding dilution totally, and then use cash flow from Yaramoco and Seguela to then build that, we're actually starting to look like a real business as opposed to a mining company, because we're taking earnings, genuine cash flow, and reinvesting at an increasing return on investment.
That's what interests me. That's what interested me when we talked last online. The model was different. It seems to be a business which understands the needs of investors. So you're not asking them to continually fork out or diluting them. You're creating your cash to give you optionality, which is great. Are we going to see dividends at some point?
So an interesting thing, so a book that I've read, and I've read it a couple of times now, is Outliers. And maybe it's familiar.
Yeah.
It really talks about CEOs have been very impactful, and tries to sort of divine what was different about these actors or these CEOs who really compounded earnings and made extreme returns for their shareholders. And one of those is really they don't typically pay dividends, they favour buybacks. So the form of return of capital to shareholders is buybacks.
Okay.
But what they do is they take the earnings from their business and they reinvest those earnings, allocate that capital into future growth. And that's what we're looking to do. So it's not, I don't think it's certainly not a new idea that we've come up with.
But it's important for people to understand the way you think, because there are different ways you can come at this. Some people look at cost-cutting exercises, some reinvesting in infrastructure, dividends for some, buybacks, effectively same thing. So okay.
So we see. So my main job, the principal job that I have, is really allocating capital. Now, when you're a single asset, as we were with Yaramoco, it's pretty difficult. So for a man with a hammer, every problem looks like a nail.
I love that.
So you drill around and you drill Yaramoko.
Yep.
So now with Seguela coming on, we've now taken our first step into being able to really establish a competition for capital within Roxgold. So the exploration team at Yaramoco needs to be able to justify why their targets are as good, if not better, than the targets at Seguela, and then we can adjudicate with our Vice President Paul Whedon and direct the capital to where we think the best return is, both in terms of absolute returns, sort of temporal, like what's the faster path to a return, etc. So I think that's really set up an interesting dynamic for our company, that we now have the opportunity to direct cash flow in a different direction.
Absolutely. It comes back to remembering. I like the fact that you said you're not a mining company. That's great. It's one of the very few people to recognise this in this space, and what they're in existence for. And I like the approach to growth capital. It's a question of what's that eventually going to mean to new people coming in and existing people, shareholders. How do they see a return? How are you going to get them that return to mean that, so they answer this question of, well, maybe I should have put my money somewhere else. So why stick with you?
Sure.
Why come into
So I think there's two paths. So in my career, generally the happiest path to realising returns has been to be taken out. And so I've been...
Well, is that true these days? Because the multiples are not what they once were. So what would you think they would be?
Well, I think that's because we're in a cyclical business. So for me, the biggest returns come from being able to work within the cycle. So it's classic. I mean, it's easier said than done. Buy low, sell high.
You've done it a couple of times, I note.
And yes, that's right. So we've had 3 exits. One I always characterise as an honourable draw, and 2 which were, I think, very successful for everyone involved. MPI Mines back in the early 2000s and Frontier Gold had a very good team there. I worked with some very good mining professionals, and Newmont acquired Frontier in 2011. And it was and they bought a really good project. Yeah. But it was a good time to sell a project.
But you weren't CEO then.
No.
Okay. You weren't running that. You're part of a team. So today, what do you think you need to create to put yourself in a position to, if you wanted, be taken out?
So my whiteboard has 3 projects, 3 operating projects on it. Yeah. And then a potentially world-class scale asset in the future.
Okay.
So we've taken our step towards getting 2 of those. So we've got our second mine.
Right.
So sequentially we'll build that. I would love to find another Seguela or something similar that's hiding in someone's portfolio that they.
But where's the bit where you're making investors money? Because spending money on stuff, great. So how does this three plus one world class asset convert into a big payday for investors?
Well, I think so. I mean, I think compounding those earnings and making sure that if our share count has stayed tight, then those 374 million shares that we have on issue today are earning a lot more cash. Now, I think you get down to a debate, and maybe it's a bit more philosophical as to whether people want cash in their hands or whether they want to have that cash reinvested and continually grown at a higher and higher rate.
I'd say both, because it mitigates their exposure.
No, that's right. So I think so for us, we think as long as there are opportunities to continue to reinvest capital at sort of the returns we expect to see from Seguela and project number 3, we would recommend continuing to do that. I would like to ultimately have an asset that's in the pipeline that has the potential to be a real game changer, and that's probably taking some geological risk and investing in it, and moving along, and ultimately, I mean, one of the case studies that I like to look at was Redback. A very successful company, made a lot of money for its shareholders, had a good mine at Chirano in Ghana, I think doing around 200,000 ounces. And then they had a massive project at Tasiast in Mauritania, eventually proved irresistible to Kinross, and they came in and paid something in the order of, I think, $8 billion. So the shareholders who were sitting in Redback 5 years earlier probably didn't envisage an $8 billion payday. But I think that's sort of I think if you get the timing right and you've done a good job building a compelling business.
Well, yeah, obviously that's the dream, because that's a really good example. Putting it in today's language, what are you trying to be? I mean, $8 billion company from where you are today, you got a ways to go, right?
Yeah.
So,
but I mean, I think to be a $5 stock, Roxgold needs to take its 374 million shares to around 1.6, 1.7 billion.
Right. Now,
from a $300+ million market cap, this is all US dollars. Now, that may seem a little ambitious, but from what I've seen in the past, when the market and the cycle is in your favour, then there's the opportunity to make an outsized return, and that's what we're sort of looking to do. So we don't know when or if that will happen again. If history's any guide, it will happen. It's just hard to predict when. So what we're going to do in the meantime is build a company that will be irresistible, both to investors along the journey and also potentially a large acquirer in the future.
Okay, thank you. Let's talk about the future.
Sure.
Last time you wouldn't give me a number about the gold market, because you've been around too long. you know not to fall for that one. But the gold market, since we spoke, has started moving. There are some signs that it's heading the right way. So you talk about timing a second ago. How long do you think this cycle will last, or do you think it's just unpredictable these days?
Look, I think it's definitely unpredictable. So I would generally stick to my practice of not providing numbers. Certainly not numbers, and certainly not times. But I think as a broad direction of travel, it looks extremely positive for precious metals. I think we've seen an unprecedented
$1,800.
Oh, I think that's well within range. I don't know when, but if you look at gold in the 2000s, when it came off its lows of around 250 at the turn of the millennium, it ran pretty strongly up, and then when we had the GFC, immediately around the GFC, gold didn't perform very well at all, and then you had a bunch of radical action, and then gold took off, and then it's come back down again, but still pretty high. I mean, over north of $1,400 historically is not a bad gold price.
Yeah.
But I think as we see the liquidity start to unfold, central banks looking after their balance sheet, and maybe some normality return, then gold stands a very good chance of seeing new highs.
Well, it'll be happy days if it does.
Absolutely.
John,
brilliant.
Appreciate your time. Great insight into the business and your thinking, which is what I think people appreciate, understanding the nature of the people behind the decision making.
My pleasure.
So we'll see you again soon.
Okay.
Thanks very much for watching. We hope you enjoyed that. And if you did, please click the button in the corner of the screen to subscribe to our YouTube channel. You can also catch us on our website, cruxinvestor.com, and Cruxcast, our podcast series. Plus, most days you can catch us on LinkedIn and Twitter. We'd love getting your feedback, so please keep that coming, and we'll speak to you again soon.